All right,
All right.
welcome everybody to the November 3rd, 2022 podcast. I'm Tony Marlette Jr. with my co-host Tony Shore over at Grady, and I'm taking over for Chris today. Good morning, Tony.
Good morning, Tony.
We're gonna
Yeah,
confuse our listeners today. I know it.
we really are with two Tonys, and I always say you can't have too many Tonys, but yeah, Tony Marlette Jr. and Tony Shore today, but we're here because Chris is not. He is actually taking a well-deserved, I should say, vacation.
Yes, he is.
Although we still envy and loathe him for it,
We
right?
do. We do.
Yeah, I think that's
We absolutely
important
do.
to note. So,
Yes.
yeah. Well, I hope he's having fun in Florida or wherever he went. And it's funny. He probably went down there to get away from the chilly fall air, but it's been beautiful out. So,
That's ironic. Yeah, it really
yeah.
has. The other night, we were sitting out, my wife and I, for Halloween. We usually have a bonfire, and we did the fire this year, and we were hot. It was a little hot out
Yeah,
with the
yeah,
fire.
yeah. Isn't that crazy?
Yeah,
Yeah, we do that too. We had a bonfire, and we really didn't need one. We weren't even sitting around it because
right.
it's like, wow, yeah, we don't need the heat tonight, which is rare for Halloween in this area. So,
Sure.
well, Tony, there's so much going on right now. It's crazy. Obviously, we all know, and we've talked about it on past shows. The markets this year are crazy, and now we have the midterm elections. So, and the elections can affect the markets as well, and I think they probably are the speculation, right?
Absolutely. Yeah. And you know as well as anybody, really, it's fear and greed that rules the markets. It's all perception. There is some factual data built into the markets, but at the same time, a lot of it's driven, like you said, by perception. So
Yeah.
we do have one more thing to throw in one more wrench to throw into 2022. We've had inflation, we've had interest, we've had geopolitical. Now we have midterm elections on top of everything else.
Yeah, well, we've had a down year in the markets, a down year with bonds, a down year with gold and precious metals, which to have a down year significantly down in all three is rare and unheard of. And the inflation, as you mentioned, is crazy. I think it hit,
Unbelievable.
it
Yeah.
was over 9% at one point this year. And on top of it, the Fed raised the interest rates again this past week. So
Yes.
another 0.75%, which is going to slow the economy down probably even more and push us further into the recession that we're currently in. And on top of it, though, like all that, which we've talked about and been talking about all year, but now the midterms come up. So it'll be interesting to see what that does.
Yeah. And I mean, the interesting thing I find about everything that you just mentioned, everybody remembers 2008. If you just say the
Yep.
year 2008, people are automatically going to think of the global financial crisis.
Yep.
In 2008, you could have shifted your money, your investments, if you timed it right, from stocks into bonds and still not lost. That's not the case in 2022, which I find fascinating because you don't think of us right now being where we were in 2008, but 2008 bonds were positive.
Yeah.
And right now, 2022 bonds are down 14, 15%, almost as much as the market. And the market
Right.
came back in October.
Yeah. Yeah, it came back a little bit. So it's down overall for the year still quite a bit, but I can't believe bonds are down almost as much as stocks. And that rarely happens. I mean, there's that old 60-40 rule. If you have 60% of your savings for retirement or savings in stocks, you want to have 40% in bonds because if the stocks go low, the bonds usually do better. Well, this year, everything's down, even
Right.
gold, So
That's a
uh,
great point.
it's a crazy year. It's the inverted yield curve. The whole works we're getting thrown at us this year.
You're right. And throughout all this, earnings have been strong. 71% of companies in the S&P beat their earnings. And
Yeah.
that's even, you look at that, like, what if that was not happening? How much worse would things
Oh,
be?
yeah. because really that should be and has been the primary indicator of stock value. Is really, it comes down to how well is the company doing,
Right.
right?
Absolutely.
So, but the stock looks forward, the stock market looks ahead. It doesn't really look back. And so what we're seeing is based on what it thinks is going to happen next week, right?
Absolutely.
Yeah.
And to your point about interest rates, I do think some of the good market fortune, if you want to call it that we had in October was already taking into consideration a Fed interest rate increase that we saw
True.
this week, like you mentioned. But
Yeah,
yeah,
we knew that one was coming. I mean,
right,
luckily that wasn't a surprise to the market. We still did see a drop the day it was announced in the
of
markets
course.
again, but it wasn't tragic. So it is interesting though if they keep. I wonder how much more they're going to raise the interest rates. I mean,
Well, their verbiage yesterday or this week had signaled that some of this might be easing. They may be easing their stance a little bit, but that remains to be seen. They also they use the now infamous word transitory at the beginning of this year, which
yeah, they did.
did not age well. But
No. About the second week after about 2 weeks after they said it, we knew it was a lie.
yeah, yeah.
Or it
So who
was
knows?
false.
I
Yeah.
mean, I think if we might have one more rate increase in 2023. I think if we go well into 2023 and we're still doing rate increases, that's probably going to be a shock to the markets.
Yeah, for sure. So, speaking of the markets, I mean, we're still down for the year quite a bit, right?
Yes.
Even though
Yep.
we saw an uptick in October, we're now in November and the markets are still volatile up and down. And as of the recording of our show, the elections haven't happened, but they
Right.
will in a couple of days from when
Yeah.
we first post this. So, interesting, right? I mean, what do you foresee happening? The results of the election could very well affect the market one way or the other. I think we'll see an uptick or a drop. I think it'll be significant one way or the other, right?
No, I think you're right. Just as kind of a refresher, we have the midterm elections coming up, and basically, what's up for grabs. And I'm not a historian or a civics professor, certainly, but or a government professor, but you have this advantage now in the House where it's 220 to 212 for Democrats, and you have a tie in the Senate with the vice president being the tiebreaker for the Democrats. So essentially, every seat in the House is up for grabs, and then 35 Senate seats. So the goal here, obviously, the Democrats want to hold on to their majority, and obviously the Republicans want to take that over.
Yeah.
Projections have the Republicans taking over at least in the House.
Yeah.
And the Senate is, I mean, it depends what day you look at polls and who you're listening to. I've heard when you hear things like it's, this way it's leaning one vote towards the Democrats one day, one vote towards the Republicans the next day.
Yeah, it's crazy, isn't
It
it?
is. It is. So you can
Yeah.
surmise from that the Senate is going to be very close. I think
Yeah.
it's almost a foregone conclusion that the Republicans will take the House.
Yeah. Yeah, I would say so. And maybe the markets will respond well to that. I think typically they
So
respond better to the
yeah,
more conservative party. I think that what they will like is if there's gridlock. Obviously, the markets like gridlock, right, Tony? Which is
absolutely,
ironic. They don't like change. So
absolutely,
if they like the weird thing is this. I don't like it, but the stock market loves the do nothing Congress when
right.
there's total gridlock. So if the election turns out where we're going to have a lot of gridlock again, where it's really close to being even, then I think the markets will be more stable in that scenario. Whereas if there's a red wave per se, maybe the markets might not like that because then there will be change, and it doesn't like change, right?
Yeah, correct. And to your point earlier about not having a huge swing based on the midterms, typically in a midterm election year, in the weeks leading up to it, we do see a small increase in the markets, usually averages less than 5%, but
Yep.
no less an increase. So this year obviously is a little different, like we mentioned.
Yeah.
There's, let's just say if the hope was that the Democrats retain their majority, or the thought anyway, the projection was that they retain their majority. Many people in a market cycle would say, well, that's great because, like you said, no change. And then second of all, increase potential for increased spending. Now, even if that were to happen this year, if the Democrats were to say maintain their majority, we've already spent ourselves into oblivion. And that's really both sides. We had the Trump presidency, we spent a lot on COVID relief. The Biden presidency, they came in, they spent a lot on COVID relief and other things too. So with a divided government being the most likely outcome, that's probably going to be the best thing for the market.
Yeah. Yeah, that's true. And we've seen so much market volatility this year. I know it's hard for our listeners to know what to do. Should I leave everything be, or should I rearrange, or should I pull some money out? I think a lot of people in 2008 made the mistake of they panicked and pulled a lot of money out, and then they missed all the gains on the upswing when it came back, because it came back relatively quickly.
Oh yeah, absolutely. Yeah. And I mean, I've been an advisor, and I've been in this business through 4 presidential administrations, 2 on each side. And right. You always run into somebody who says, you know what, I'm getting my money out of the market until blank is out of office. And if you do that, you're losing. Flat out, it doesn't matter. So I thought
the markets don't
too.
Yeah, the markets don't care who's in who the president is, especially if you're basing it on a presidential election. It's kind of crazy because the markets have been around a lot longer than any one president.
No, that's correct. And you need no further proof. I mean, if you think of Obama and Trump, people feel passionately on both sides about both those guys. Each of those guys averaged, and they did it differently, but they averaged 16% rate of return on the market. And that's all you need to know right there.
Yep, exactly. So, yeah, you can't let politics sway your investment decisions, is what you're saying. Is that what you're saying? Yeah.
Yes.
Yeah. So that said, the midterms are a major election, and they can bump the market one way or the other. But the key is, and you guys have said this, Tony, you said this, and Chris always says this, the key is what is your time horizon? What you do when the markets are this volatile is based on when you need the money, or when you're going to have to pull it out. If you have another 10 years before you need any money in the market, it's probably maybe best to just leave it be, right?
Absolutely. It's divided government as it is. You're averaging about 8% rate of return in the market, and GDP averages about 2.7%. So to your point earlier about markets liking Republicans in the Congress, the majority better, you're correct. I was a little surprised when Democrat presidents have had better markets than Republican presidents.
Yep. The history shows that when Democratic presidents have been in, the markets have been better overall since, if they look at all the different presidents. So overall, it's up during Democratic administrations. Congress is different. So that's different. So really 2 separate things. So the executive branch is one thing, and the legislative branch is another. And you have to keep that in mind as well. But I mean, midterms are crazy. Tony, if I see one more political ad, I literally probably got 100 emails. I don't know how I got on these lists, and from both Democrats and Republicans too.
Mm-hmm.
Not just from the party I voted last year, but from both parties.
Yeah.
And and I'm starting to get texts, and I never got texts before, but I'm getting political texts,
Yeah.
political emails, and I can't watch a show or stream something on the
Yeah.
internet without seeing political ads are on the internet and they're on my television. So how do I escape it, Tony? What do I do?
You got me on that one. I'm getting the text too. I mean, you escape it on November 9th when there's no more. Yeah,
Yeah.
I had a teacher back in the
Actually,
day.
if you notice, the ads will run like on radio and stuff because they're contracted. So a lot of times you hear political ads the day after or a couple of days
Oh,
after.
because they paid for them already, so they might as
Yeah,
well run them.
and like text messages, you can still get them within a couple of days after the election. A few days, they go past the election, which
Yeah.
I can't wait until these midterms are over.
Right. I had a teacher, might have been a government or a civics teacher in high school, tell us, and I always thought this was interesting. Why don't politicians run ads for themselves when it's not an election year? Why don't they run ads if they really wanted everybody to know and they really were operating in everybody's best interest? Why wouldn't they tell people, during a football
Hey, I just
game?
accomplished this. Yeah. A big ad going, "Hey, I'm proud as your state senator.
Right.
Here's my list of accomplishments. I wanted to let you all know that we're working hard for you." Right?
Yep.
Yeah. You never see that.
No.
They don't
No,
spend a
not at
dime
all.
on that. It's all hinged around getting elected, but you'd think the long-term play would be good, but
Yeah.
I guess not. You're right. That's a good point your teacher had.
Yeah. I was always interested in that too.
Yeah. Oh, yeah. Politics fascinate me, and they can be so frustrating, especially as of late.
Yeah.
With the partisanship and just crazies on both sides. I would like to see them get back to serving the people and shoring up our country. No pun intended.
Yeah.
Shoring it up.
Yep.
Yeah. So, and market volatility, but there are options out there. You don't have to have all your money at risk in the market, right?
Well, no, that's right. And again, back to, people who, anchor their political views to how they invest their money. You shouldn't first of all, like we said, you should never do that. But then you don't have, if the volatility scares you and the volatility worries you, you should get out of the market. I know nobody likes it. Nobody likes to see red, but if it worries you, we need to take some of it out of the picture. And here's the kicker: we don't want you getting back in when the market goes up. We talk about it all the time. Time in the market, not timing. If you miss those top days, 5 days out of the top 5 days out of a 5-year span or a 10-year span, your returns get cut in half. That's all it takes.
That's crazy.
It really is. It's and that graphic has that chart has stood up. It stood the test of time because it's still accurate today. If you miss the top days, your returns get cut. But the point is, you want to manage your strategy based on your goals, your time frame, and your circumstances.
Yeah.
Crafting a plan with taking Social Security into effect, taking any pension, spousal assets, expenses, lifestyle, retirement goals, all that definitely takes priority over what's going on in the market now or what's going on in DC. Because to your point, the politicians in DC don't care whether your money's invested or not. You're not affecting them negatively. If Chris were here, he would say, "How do these people get so rich?" And it's
right.
It's a valid question.
Yeah, it is. It is. How are no major politician like senator or whatever ever retires, upper middle class. They're all filthy rich.
Correct.
It's like, how did that happen? So, that said, I think you really hit on something there. The key is have a plan, and everybody's situation is different. I mean, we're talking in generalities today about investing, But I know that you and Chris really pride yourselves on doing what's in your client's personal best interest. So what you do with your money, how much you have in stocks, how much you have in bonds, how much you have and what type of insurance you have and insurance products and healthcare and social security maximization. You look at the big picture, go through each thing and really customize it to the individual, right? And that's what our listeners need to understand, is that they need to find a trusted financial professional, a financial advisor to help them do that, right?
Absolutely. And we cut out some of the noise that way. To me, if you're working with a professional, everybody's going to be concerned. Everybody's got ideologies. Everybody's got their beliefs. I'm not saying you're not going to be concerned about what's going on in our country. My point is, if you're working with somebody, we cut through the noise so you don't have to worry about how is this specific thing affecting my portfolio. I tell people, we help save you from yourself sometimes.
Right.
If you don't like something that's going on and you're managing your own money, it's an emotional reaction. People are not robots. People have feelings. Everybody's got emotions. You might go in and get yourself out of a certain investment or a certain index, or get yourself back into something. We're there to coach you, to say, hey, this is our strategy. We're sticking to it. And this is why we're allocating you in this way.
Yeah, there you go. Well, I think that's great, Tony. And this has been a great show talking about what's going on out there with the markets and what may or may not happen with the midterms. But before we go, let our listeners know how they can get a hold of you and Chris to set up that no charge, a no obligation consultation, get a plan in place, and get some reports run to see where they're at.
Yeah, perfect. You can, of course, give us a call, 440-886-3550, or visit us online, schedule an appointment online at brooksidetax.com. If you reference this podcast or any one of our videos, your consultation will be at no cost, as will a copy of any one of our books on retirement planning and estate planning as well.
Yeah. Well, that's great. And again, that number is 440-886-3550. And Tony, great show today. I mean, Chris, we did fine, right?
Yeah, I mean, who needs them? Come on.
I wasn't going to, I thought it. I almost said it, but I'm glad you said it. Yeah, come on. No, we love Chris. I'll tell you what, if taxes had come up, we would have missed him today, right?
Oh yeah, that's why. Yeah, I kind of yeah.
Estate planning and taxes. He's probably the smartest person I've ever met on those two topics. He's serious.
You're right. He is an absolute whiz when it comes to that stuff. And I mean, that's part of, not to turn this into a big advertisement here, but that's part of, what differentiates us from other financial firms too. I mean, is straight up, it's Chris. It's the holistic approach, taking everything into consideration with an estate plan and tax prep to go along with everything else.
Yeah, exactly. And I think that's so key. Well, listeners, Tony, first of all, thanks. Great show. And listeners, that does it for today's episode of The Road to Retirement with our host today, Tony Marlette Jr.
All right. Thanks, everyone. Thank you, Tony. Talk to you.